Let's take a moment and talk about diversification. It's a widely used term in the industry. What does it really mean? So let's start with the dictionary definition as it relates to investing. It says the act or practice of investing in a variety of securities so the failure or economic slump affecting one of them will not be disastrous. I think we'd all agree with the premises, which is you don't want to have all your eggs in one basket. That said, diversification does not guarantee profit or protect against loss in declining markets. A properly diversified portfolio will typically have one area doing well, one another area lags, and then it'll switch. And the area that was lagging will start to do better, and the area that was doing better will start to lag. There's just no way to know when that switch happens. So that's why it's really important to stay diversified. So when you go through diversification, is there a process that you can use to actually do that as it relates to investing? And I do believe there is. So once you have your plan completed, you're going to determine what percent you want to have in stocks, bonds, cash, or alternatives. And just as an aside, alternatives are anything that doesn't fall into the other three categories. From a cash perspective, you want something really simple that's liquid, like a money market or a savings account. Within fixed income, you want to use what's called a ladder. And a ladder allows you to diversify your fixed income by maturity. Let me explain what I mean. So let's say you decided to allocate $100,000 into fixed income into a 5-year ladder. Now you can choose any time frame. We're just using 5 years as an example. So in this example, we'd put 20,000 into a 1-year bond or CD, 20,000 a 2-year bond or CD, 20,000 to a 3-year, et cetera. So we essentially have the same amount coming due every single year. The reason you do that is that way, if interest rates were to rise in a year and you have that first bond coming due, great, we can reinvest those proceeds in the new higher rate. But if rates stay the same or go lower, then hey, great, good thing we locked in those better rates later in the ladder. And again, you can choose any time frame you want. On the equity side, I believe that there are 5 core areas we want to be diversified: large growth, large value, small growth, small value, international. And we're going to equal weight them because there's no way to know when international, for example, is going to do better than large growth or vice versa. So you put the same amount into each area. And the reason we did that is if you break down the market into its simplest form, you really have 2 investors out there, in my view: growth or value. A growth investor might buy stock at 10 because they think it's going to grow to 25 in the future. Maybe it's a biotech company, they have a new drug hitting the market, and revenues go up, stock price goes up. So that's kind of the growth investor. The value investor is somebody who wants to buy a stock at 10 today because they think it's worth 20 right now. So they think it's cheap. And really the difference is perspective, because in any given period of time, growth would do better than value. Again, there's just no way to know when that happens. So you want to be diversified within that. Further, you have small, medium, and large companies that fall into these different categories. So again, another opportunity to diversify because those companies act differently in different environments. One thing to note about small and medium-sized companies is that they're generally more volatile than large company stocks. They involve higher risk because smaller companies may lack the management expertise, financial resources, product diversification, and competitive strength to endure adverse economic conditions. And the last area that I mentioned was international. And international just means the company is not headquartered in the US. It doesn't mean they don't do business here. They're just not headquartered here. A very high percentage of publicly traded companies are based outside of the US. So you want to make sure that you have some diversification there because otherwise you will miss out on some great opportunities. Investing in foreign markets presents certain risks not associated with domestic investments, such as currency fluctuation, political and economic instability, different accounting standards. This may result in greater share price volatilities. And I don't guess which area is going to do better. Again, there's no way to know that. So you want to put an equal amount into each area. So whether a client has 100% equities or stocks or 50%, that ratio within that 50 or 100% is the same in those 5 core areas. For simplicity, let's say we put 20% each one of the 5 core areas. And let's say a year from now, large growth is now 25% of the portfolio and small values at 15%. Where then we're going to take 5% from large growth, add it to small value, get them back to equal footing, because invariably what will happen again is that the area that was doing better will start to lag, and the area that was lagging will start to do better. And by rebalancing, which is done on a client-by-client basis, it forces you to keep things in even keel. Thank you so much.